So why has a multi-trillion RMB financial giant completely captured Wall Street's attention in what is arguably one of the most complex economic environments in the world? Well, welcome to The Explainer. Today, we're diving deep into a really fascinating institutional analysis of China Merchants Bank, or we'll just call them CMB to keep things simple. If you're into that perfect intersection of massive scale and rapid strategic agility, you are absolutely in the right place.
Okay, here is our game plan for today. We'll meet the banking giant, dive into their Q1 2026 financial results, check out the Analyst Consensus, explore CMB's competitive moat, and finally look at the risks you need to consider.
All right, part one. Let's meet the banking giant.
CMB's rise, it's been literally meteoric. I mean, they started out as a little Shenzhen startup back in 1987. Fast forward, they listed in Shanghai in 2002, hit Hong Kong in 2006, and today, they're China's 7th largest listed bank by assets. The really crucial thing to understand here is their footprint. They operate mainly in the Pearl and Yangtze River deltas. Those areas are the absolute economic engines of China, so CMB is deeply rooted in the wealthiest, fastest-growing markets out there. Now looking at who actually owns them, the China Merchants Group anchors the whole thing with a 30% stake, which provides a really solid bedrock of stability. The other 70% is held by public and other shareholders. And that 30% anchor is so important because, guys, this is a massive operation. We're talking about 122,000 employees. That is basically a small city of bankers serving a colossal retail customer base all across the country. And Morningstar actually highlights their secret sauce perfectly. It's an enviable funding cost advantage. Because they have such a dominant footprint in retail banking, they get access to this giant pool of low-cost consumer deposits. Basically, they just get their money cheaper than the competition. That structural edge is exactly what lets them deliver top-tier equity returns even when the broader economy hits a rough patch.
Moving right along to part two. Let's look at their Q1 2026 financial results.
So in just the first quarter of 2026 alone, they pulled in operating revenue of nearly 87 billion RMB. Let that sink in. Generating that level of cash in a single 3-month period, it is a huge testament to the sheer velocity of money flowing through their system, especially when you think about the industry headwinds we've all been hearing about lately.
Year over year, operating revenue ticked up 3.8% and net profit grew 1.5% to almost 38 billion RMB. But here is the real kicker that you wouldn't catch just glancing at the annual numbers. That growth actually sped up on a quarter-over-quarter basis. And honestly, even more importantly, the pressure on their net interest margin, the gap between what they pay for deposits and charge for loans, that pressure significantly eased up compared to 2025. That acts like a massive relief valve for their bottom-line profitability.
Under the hood, management is pulling off a seriously smart pivot. Corporate loans absolutely surged, up nearly 13%, intentionally offsetting a much slower consumer retail lending environment. And that's no accident. They are shifting gears, pointing their firepower right at corporate lending to match what the demand actually is. For a bank this huge to show that kind of agility, pretty impressive.
All of that strategic lending and deposit gathering pushes their total assets to a staggering 13.48 trillion RMB. That's a jump of over 7.6% from the year before. So they're actively expanding this massive footprint, all while keeping a rock-solid capital adequacy ratio to support that sustainable, long-term growth.
Okay, part 3. Let's talk about the Analyst Consensus. The smart money, like Goldman Sachs, is decidedly bullish here, holding firm on a buy rating. But their reasoning is what's really wild. They actually expect CMB's profit growth to beat out the 4 major state-owned banks this year. Beating the big 4 state-owned banks is a massive flex in Chinese finance. They're seeing a stabilizing net interest margin and recovering credit growth driving a real rebound, plus a ton of fee-based income from their wealth management wing. And if you want relative value, look at these metrics. At just under 50 Hong Kong dollars, the H shares, which are just shares of mainland Chinese companies listed in Hong Kong, are trading at a price-to-earnings ratio of just 7.9. The price-to-book sits at 0.97, meaning you're technically buying it for slightly less than the accounting value of its assets. But the absolute star of the show here is that 4.6% trailing dividend yield. That makes CMB a phenomenal income play if you want to get paid while you wait for capital appreciation. Moving to part 4, CMB's competitive moat.
So what's actually protecting them? It basically boils down to a 4-pillar fortress. First, an unbeatable retail wealth management franchise with 16 trillion RMB in assets under management as of mid-2025. 16 trillion.
That literally rivals the GDP of entire nations. People trust them with their money. Second, that sheer scale gives them a super stable, low-cost funding base. Third, management has a proven, rock-solid commitment to steady shareholder returns and dividends. And fourth, they have a really positive revenue outlook for 2026, with that margin compression finally narrowing. It's an incredible defensive setup that still leaves them plenty of room to play offense.
Finally, Part 5, the risks to consider.
Now, to keep things totally objective, Morningstar drops a vital reality check here. The broader environment right now features falling interest rates and generally pretty weak consumer demand. Because of that, competition between banks for consumption loans has gotten fierce. Basically, everyone is fighting tooth and nail over a shrinking pie of consumer borrowing, and that is actively dragging down the average yield CMB can actually command on those loans.
And that dynamic creates some very specific risk factors. While corporate asset quality is getting better, retail assets are definitely feeling the squeeze of the wider economy. On top of that, total bank card fees might underperform if consumer spending stays cold. Oh, and we have to mention real estate. There are still some lingering exposures from late 2025. Now, management is adamant that this was a one-time thing and it's fully provisioned for, meaning they've literally set aside the cash buffer to absorb any potential losses, but it's still a macro factor you've got to watch closely. Which brings us to the ultimate question to leave you with today. Does a massive 16 trillion RMB retail moat, paired with a juicy 4.6% dividend yield, provide enough armor against the risks of a shifting and highly competitive economic landscape? The analyst consensus is pointing to a stabilizing 2026, but looking at those underlying dynamics, what do you think?